Ladies and gentlemen, good day, and welcome to the Q3 and 9-month FY26 earnings con call for Sastasundar Ventures Limited, hosted by Go India Advisors LLP. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Soumya Chajit from Go India Advisors LLP. Thank you, and over to you, ma'am.
Good day, everyone, and welcome to Q3 and 9-month FY26 conference con call of Sastasundar Ventures Limited. We have on call with us Mr. B.S. Mittal, the Chairman and Executive Director, Mr. Lokesh Agarwal, the Chief Financial Officer. We must remind you that the discussion on today's call may include certain forward-looking statements and must be therefore viewed in conjunction with the risks pertaining to the business. I now request the management to take us through the recent business update. For that, we'll open the floor for Q&A. Thank you, and over to you, sir.
Thank you. Good evening, everyone, and thank you for joining Sastasundar Ventures Limited's earnings call. We sincerely appreciate your continued interest and support as we progress through an important phase of our growth journey. Our philosophy has always been rooted in combining medical science, technology, and purpose-driven growth to make healthcare affordable and accessible. The core commitment continues to shape our strategy and execution. During the year, after a steady revenue from last 3-4 quarters due to automation, our growth came back, and therefore from Q2, our revenue have risen by 11% Q2Q and by YOY 22%. There is an expansion in gross margin also from last quarter 7.4% to this quarter 7.6%, and from December 24, 6.1% to 7.6%. During Q3 F26, our business continued to demonstrate steady operation traction across both B2B and B2C verticals, reflecting disciplined execution and sustained customer engagement. For the 9-month period ended F26, our performance remained resilient despite transitional challenges witnessed earlier in the year. Growth momentum was supported by improved vendor sourcing, optimization in procurement processes, and automation across fulfillment and supply chain operations. Both our key platforms, Retailer Shakti and Sastasundar B2C, continue to remain central to our growth strategy. Retailer Shakti maintained stock order volume supported by deeper retail penetration and enhanced supply chain efficiency. Meanwhile, Sastasundar B2C delivered robust growth supported by improved customer engagement, stronger repeat order behavior, and expanding product categories. Our performance continued to reflect the strength of our capital efficient model. Over 9-month FY26, we maintained stable revenue growth and improved profitability metrics, supported by better product mix, improved vendor terms, and disciplined cost control. My dear friends, we have posted a very extensive presentation this time in Stock Exchange. I would request all of you to read very carefully each and everything about the business model, how we are the most capital efficient company in the country, both in terms of capital efficiency, both in terms of working capital efficiency, and a highly growth oriented platform we have been able to build. I am pleased to say that we remain firmly on track to achieve our stated guidance. Retailer Shakti is progressing towards EBITDA breakeven by Q4 FY26 and expected to deliver sustainable EBITDA positive performance in FY27. The Sastasundar B2C is progressing towards contribution margin positive in FY27 with operating leverage improved as order density and customer acquisition efficiency strengthened. And as you have seen in the balance sheet that how we are funding our growth, which is required in a tech-oriented business, that our total investment for futuristic technology is less than our treasury income, and thereby the cash flow is remained positive by virtue of our treasury income. For the future, our focus remains anchored on 3 key strategy priorities. One is technology and growth infrastructure. We continue to invest in building a high-tech AI-enabled platform that enhance customer experience, improve supply chain efficiency, and strengthen personalized capabilities. These technology investments are expected to deliver measurable operating leverage benefit beginning FY27 as adoption scales. Expansion across categories and geographies. We are actively expanding product categories, strengthening vendor partnership, and increasing penetration across unserved geographies. These initiatives are expected to support sustained growth momentum over the next 2 to 3 years. I am very happy to announce that we already launched our Jito brand. This Jito is a very progressive strategy to distribute generic offering under our own brand. And I am happy to announce that we are the only distributor, or we are only the healthcare platform which has a relationship with around 65,000 retail pharmacies. So quickly we will integrate all our pharmacy retailers to our Jito distribution network. So overall, our vision remains to build a leading healthcare platform that combines innovation, empathy, and technology to deliver affordable and accessible healthcare solutions across India. With a strong platform engines, Retail 13, B2B, and Sastasundar B2C, we believe we are uniquely positioned to create a scalable and sustainable healthcare ecosystem. With this, I will now request our CFO, Mr. Lokesh Agarwal, to take you through the financial performance for Q3 FY26. Lokesh.
Thank you, Mittalji. Good afternoon, everyone. This side Lokesh Agarwal. So I'll take you through the financial performance of the company for this quarter. During this quarter, that is quarter 3 financial year 26, we marked a strong operating quarter for the company, reflecting a healthy top-line growth, meaningful improvement in profitability. So you would notice that our revenue from operation has increased to 341 CR for this quarter, registering a growth of 22% as compared to year-on-year growth of last compared, which is driven by sustained traction across both B2C and B2B businesses. Gross profit for this quarter has increased by 55% year-on-year as compared to last quarter, while the gross margin has increased to 7.6% as compared to 6%, reflecting an improved product mix and operating efficiency. While employee benefit expenses increased year-on-year in line, which is in line with our strategic investment for talent acquisition and investment in technology, while other expenses are moderate and remains in line with our revenue. EBITDA losses have significantly narrowed down to negative 14 CR, which has improved year-on-year by 41%, while the EBITDA margin has improved by 4% in the corresponding quarter of last year. Supported by higher other income, the company reported a sharp turnaround at the operating level, wherein the EBIT turned positive at positive 1 CR compared to loss of negative 37 CR of quarter 3 of last year. Further, you would notice 9-month financial performance has also improved drastically. The company reported a revenue of 928 CR approx, reflecting a 15% year-on-year growth driven by steady performance across core segments. Gross profit has increased 30% year-on-year to INR 70 CR, while gross margin has improved by 80 basis points. We ended up with 7.5% gross margin for 9-month period as compared to 6.7% of corresponding period last year. Improvement in our operating efficiency and higher other income supported a turnaround in our profitability, with the company reporting PAT of positive 11 CR as compared to loss of negative 151 CR in 9 months FY25. Overall, the performance reflects the company's focus on scaling revenue while improving operating efficiency. We are continuously investing in technology, talent, and in our platform capabilities to translate into stronger margin, profitability, and positioning the business for sustainable growth ahead. Thank you. With this, I leave the floor open for your queries.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Amit from Robo Capital. Please go ahead.
Thank you. Thanks for the opportunity. So my first question is on HealthBuddy. So what is the count currently, and what do we expect the count to be next year for HealthBuddy, like next 2 years or so? And secondly, on HealthBuddy, what is the burn rate currently, and also what are the top 2-3 items where there is a burn? Because I think on unit economics level we may not be bleeding for HealthBuddy.
Yes, you are very right. So the HealthBuddy model itself is a positive edge contribution level. We don't burn in even a single penny out of the delivery. So current now there are 293 HealthBuddies at the platform, and we will grow around 50 to 60% year by year. So by 31st March F27 we should be around 400 HealthBuddies, and then we grow continuously. And the top item of case burning or case investment is our salaries, and advertisement. So the salary part is around 15 crores for B2C platform building, and around 11 crore is our revenue advertisement. So these two things are basically case investing items. From transaction level, we are case positive, and we will continue to be case positive. So there is no case burn in transaction.
Right, sir. And these salaries, these are essentially for the IT team or for the building the platform. Is that right? Or these also include the delivery salaries for those who deliver the product?
No, we don't deliver the product because the products are delivered by HealthBuddies. So there is no delivery cost attached to this. These are purely tech-oriented people who are building the futuristic tech capabilities. So these we don't factor into our futuristic investment. We have a separate ecosystem building cost. So Sastasundar, the B2C retail platform, we are building a unique platform to provide the personalized services by artificial intelligence using, say, counseling based upon our data, and B is the quick health delivery model which we are launching, and 3 is the Jito generic module by which we can provide the clear insight how the generic medicines may be cheaper for customers, and 4th are the health records. So these are the futuristic plans of which our team is building platforms. So these are not related to current infrastructure or current offerings. These are purely futuristic offerings upon which we are very, very positive, and these are very measured investments by us.
Right, sir. Thank you. And secondly, on the retailer Shakti, sir, how do you see growth going forward, like say a couple of years from now?
So we internally we have planned that we shall grow by 30% plus year by year for next 10 years, so 5 years. That is how we planned the growth. These are subject to so many variations upon Q to Q or even 1 year. So there may be some quarter where we grow slowly. There may be some quarter we grow fast and rapidly. But if you ask me next 5 years to 10 years, then we target to grow by 30% plus CAGR for 5-10 years.
Thank you, sir. And the last question, if I may, is on the corporate action. There is I think a merger planned. So maybe you can throw some light on the corporate action on, or what is the plan now?
So this is very important agenda for all of us. So earlier the SEBI has made a condition that there has to be a QIB to hold 25% equity post issue to maintain the public shareholding. So we are working on that part, and after closing of this account for this financial year to 26, we will approach to our board of directors to grant the merger approval. And subject to that merger approval, we must be completing the merger and demerger process in the next financial year.
Okay, sir. That's it from my end. Thank you and all the best.
Thank you.
Thank you. Before we take the next question, a reminder to all the participants that you may press star and 1 to ask a question. The next question is from the line of Avnish Tiwari from Vaikarya Fund. Please go ahead.
Hi.
Hello.
First question I had was this GST change which happened last year. So all the inventory you had at a higher rate of GST, how did you consume that? Like, how did the marketing companies compensate you for that?
So marketing companies, pharmaceutical companies have not compensated. They have given 1 month extra credit as to all the participants in the industry. So we have in our books the GST credit, which we were into the inventory, and we hope to cover up in next 2-3 years period of time.
So did it impact your gross margin for the third quarter because you had to consume this higher cost inventory and
So gross margin is right now is not enough to consume, so we are not paying any GST. But going forward, our gross margin will enhance and our revenue will also enhance. So I think in next 3-4 years, and then we are working very sincerely to increase our offering in terms of beauty care and personalized care, where the GST rate is high. So that we should compensate, so that we don't have any other option other than to wait for adjustment through our revenue.
Okay. So you're saying the GST you have already paid, to recover that you need to sell higher GST. Like in future you plan to recover that through selling items which carry GST, so you can claim that input tax credit.
Right. So out of these three things, one thing it can be that we sell other items and we increase our revenue. So that is not a very big amount. It's a very moderate amount. So we don't find any difficulty. This is a change, and change is good for country, good for the society, good for us also. The GST rate is decreased from 12% to 5%. But here some side effects are there, so we have to bear that kind of pressure on working capital. But there is not that much.
Okay, so the only impact you have on working capital, not on the gross profit or margin, because revenue and cost of goods both are excluding the GST, right?
Yes. So there is no effect on that, except that our working capital is plus for some 3-4 years time.
Yeah, working capital is slightly elevated. And to compensate for that, the marketing company gave you 1 month extra payable. Like, what was that?
They gave us 1 month extra credit, but that has gone past. So that we have availed, but right now the GST remains as it is.
Got it. Now, second question I had was that, let's say your gross margins are about 7.5%, 7.6%. And in this industry of distribution, what are the typical gross margins? Some of your competitors have reporting around 10%. Some of these other kind of distributors, smaller ones, have in that vicinity 8 to 10%. So is this business, can you help us understand your gross margin versus what we see at the larger companies' gross margin who are into pharma distribution business?
Yes, you are absolutely right, but you have to compare one after discounting the credit part. So we don't give credit. So we started our model without giving any credit. So our margin of 7.6%, if you adjust with credit, that is coming 1.5%. If you see the larger distribution company, their credit is as high as 60 days. So 60 days credit means 2%. So our credit is 0. So 2% extra, 7.6 to 2%, 9.6, that is in line with the industry. And so as we grow more, I think this credit data will be replaced by the digital data. We have started taking charges for our data management from pharmaceutical companies. We have launched Sastasundar digital platform, Sastasundar podcast on YouTube that has started monetizing. So we firmly believe that this credit data will be compensated by data and platform revenue, and then again the platform fees that we charge from the retailer. So taking together, without even the credit data, we should be able to reach around 9.5 to 10% gross margin, and then there will be substantial improvement by virtue of the Jito or brand or own level brand. So we hope that it will enhance as we grow.
Can you explain what do you do with data management for which your retailers will pay you about 2%?
not 2%, the data plus podcast plus the trade generic. So three ability we are giving to the pharmaceutical companies. Data means we have the data because our entire distribution is through digital. So we have the pin code wise data that in which pin code which retailer is buying, in which area which retailer is not buying, in which area which retailer has what kind of inventory at their stores, and which retailer what kind of inventory they are returning. So all those are digital data. Those are very valuable insights for pharmaceutical companies.
Oh, you will give it to the marketing company, you mean, right? This data.
Yes, pharmaceutical companies, we give without mentioning the name by categorizing the pin codes.
Got it. And second thing also you said, one is this activity you will do to get additional revenues. You said second activity also which will help you on a gross margin. What was that? No, your own Jito brand. I think trade generic.
Jito brand. See, I must emphasize that we are the only distributor who can integrate the pharmaceutical shops into Jito private label brand. So this is a very unique model. The ability, as of now, we are the only company which has a 65,000 retailers on board in digital medium. So we have launched them and we are making them enable to sell the generic quality brand Jito. And because now there is sustained demand from customer side, because the new customers are coming to avail the benefits, and this model, we firmly believe that along with the separate channel in Sastasundar platform Jito, this will substantially increase our revenue and this will substantially increase our gross margin also.
Got it. Typically, how much margins you make on your Jito gross margin or contribution margin, because there's some small costs involved in selling, right? You need to connect with these distributors, retailers. So what is the either gross or contribution margin of Jito?
So Jito, as you know, the platform, we have a variable expenses of around 5%. So the Jito, the gross margin will be around 30%. So 5%, 30% will be the gross margin, and out of that 5% will be the cost, as happen with other medical distribution costs. So in Jito, we will be having gross margin 30%, contribution margin around 25%.
Got it. Okay. Great. Thank you.
Thank you.
Thank you. Ladies and gentlemen, anyone who wishes to ask a question may press star and one. The next question is from the line of Aryaman from Prudent Investment Managers. Please go ahead.
Yeah. Hi, sir. So basically, like you mentioned, we don't do credit. But doesn't this create a bottleneck during expansion, the expansion that we're currently doing? Because I'm assuming the distributor here give a decent amount of credit to the pharmacies. So if you're going with no credit, doesn't this create a bottleneck in terms of growth and expansion?
We don't find any bottleneck. Rather, this is a USP. If you see the West Bengal geography where we launched first, we are the market leader, including all the credit giver players also. So if this has been the bottleneck, then we should not have been the market leader. And then looking to our second geography is Noida. We are very rapidly expanding. We are the fastest growing distributor there in Noida. And then third geography, we went to the northeast. We opened another fulfillment center, Guwahati. So there again, we are the leader. So I mean, this is a choice to the retailers that they get a transparent price. They get the commitment to deliver next day for all the medicines. And against that, we give them extra discount. And the discount is as high as 1.5 to 2% more than any other distributor. And the credit, if they get from banking channel or they get a credit from other NBFC, the credit cost is less than 1%. So if this disintegrate this credit from that distribution, that will happen in due course of time, because this credit clubbed with the distribution is very costly affair for retailers as well as for distributors, because both are into trouble. So this is an innovation, and this is our USP, and we got market leadership by virtue of that USP, and we don't find any bottleneck in growth.
Sure, sir. Thanks a lot.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all the participants in the conference, kindly limit your questions to 2 per participant. Should you have a follow-up question, please rejoin the queue. The next question is from the line of Dhairya Trivedi from DJT Investments. Please go ahead.
Hi, sir. Thanks for taking my question. Sir, just
Hello.
wanted to get... Hello, am I audible?
Yes. Yeah, you are audible, please.
Yeah. Sir, just wanted to get an update from you on the status of the new warehouses in Lucknow and Udaipur, and also on the capacity expansion in the existing warehouses. So if you can just, give an update on that, please.
Yes. So, as you have seen from the last 4 quarters, our growth was very limited, and that was by virtue of the automation in Barepur. So we faced the demand expansion very rapidly, and that made our warehouse very small in comparison to the demand. So now we're looking to the forecasting. We target first the entire Eastern India and then Northern India, and then the entire Northeast. So from West Bengal, we will be serving to Bihar and Odisha and Jharkhand and Chhattisgarh. So we need extra warehouse. So we have automated the warehouse to make the capacity double, and then another additional fulfillment centers of around 80,000 square feet. That will be in addition to 156 existing. Noida, we are again building 1 lakh square feet new warehouse. And from Noida, we can go to Rajasthan, Jaipur, Haryana. And from this side, one part of the Uttar Pradesh. So we have to build in Lucknow to service the cities like Banaras, Kanpur, Ayodhya. And then from Rajasthan, we can't reach to Udaipur side. Udaipur, Chittor, Bharatpur, Ahmedabad. Ahmedabad is very near to Udaipur. And Indore, which is also a 8-hour journey. So these are the territorial thoughtful decisions to build FCs so that we can cover a substantial part of the northern India and eastern India and northeast India and some part of Ahmedabad from Udaipur. Before we build a new warehouse in Ahmedabad, Maharashtra and southern India, so that we plan the next year. But this year, as of now, we want to cover the entire distribution triangle in the region in which we operate.
So, sir, why is this additional capacity likely to be completed?
The additional capacity we have started in West Bengal. First, so West Bengal will be completed in next 6 months. Noida we will start in next quarter, so it will take around 1.5 years. Guwahati partially we have built, and then we are building a new building there in Guwahati. That will take another 2 years time. Lucknow it will take 2 years. Udaipur it will take 2 years. So these are the 2 years planning. In the meantime, we will continue to serve from 3 FCs because we have a very large scale of FC. Those are automation process. So it takes a lot of time before we build a new FC.
Okay, understood, sir. And sir, if you can just give an update on what was the sale from Jito for this quarter?
No, Jito this quarter we have just launched. So sales is not too much in lakhs of the rupees, but I can tell you the start is very good and inspiring.
Okay, and what are the projections for the next, say, 12 to 24 months from Jito?
From 24 months, we must be reaching around 5% of the sales by Jito, and it will rise. I think next year we will be doing around 2 to 3% because initially 1 and 2 years takes a lot of time for building distribution, for building procurement capabilities, building brand, and then it enhances rapidly. So we expect that next year it should be 2% of the revenue, and then 5%, and then for next 2-3 years 10%. But we are targeting in next 3-4 years around 10% of our revenue from Jito.
Sure, sir. And we are integrating this with our existing network of pharmacies, right?
Yes, that is what the beauty is. We will build the Jito brand and Jito network absolutely a new phenomena without any cost. So there is no cost attached. We have the FC, we have the distribution, we have the technology, nothing. So I mean, this is what the beauty of any digital ecosystem is that we enhance capabilities, we enhance offering without any additional cost.
Sure, sir. Understood. Thank you. Thank you, sir, and all the best.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. The next question is from the line of Pulavarthi Saikiran from Pulavarthi Advisors. Please go ahead.
Hi, sir. Thanks for taking my question. So just quickly understanding the working capital days, looks like, especially on the payable days, there is a lot of volatility. If you can just help us understand how to think about working capital as percentage of revenue and working capital days.
So the working capital volatility remains because of the nature of the business and because of this GST environment also. So some quarter have up and down, but as a business model, say for next 3-4 years, the working capital in our business should be almost negative or 10 days working capital, you can say, because we are building a model whereby through our technology, our inventory will be around 21 to 20 days, 22 days, and that will be funded by our receivables. So fundamentally, the business will not need any capital. But yes, as of now, we need a capital until we achieve that kind of cycle. And the Jito brand will be needing some working capital, and that is a working capital intensive because we depend upon contract manufacturing. We don't have our own plant to manufacture. So that will require another 60 days working as far as the Jito brand is concerned. So yes, quarter to quarter, as I said earlier also, there will be some volatility, but fundamentally this is a efficient working capital model.
Got it, sir. And sir, as of now, as of December 2025, what is the cash on books?
Cash in, there are two parts of our company. One is the Sastasundar Ventures Limited. So one is the financial part. There is one NBFC called Microsec Resources. And one is the Sastasundar Healthbody Limited. So as on 31st March, Sastasundar Healthbody Limited has around 403 crores of treasury. And Sastasundar Ventures, other NBFC business, has around 100 crores treasury. So the total treasury in the company level is around 500 crores. And Sastasundar Healthbody Limited has 400 crores.
Got it, sir. And one last question from sir. So if you remember, you also mentioned that Sastasundar, which was like a Flipkart health business, has dropped from 110 crores to 135 crores, and then currently this quarter we have seen at 44 crores. How do you see this growing probably in the next 18 to 24 months, sir?
So Sastasundar business, I think for next year, from this year to next year, we must be growing around 100%. And the growth is coming very nicely. We are very happy. And I believe in next 12 months time, we shall reach at the level where we handed over to Flipkart. So in 2 years time, we will be happy to see that we are fully capitalized as a company. And we got the capital, from that capital, from treasury income, we are building business. And whatever we have lost, we gained again at the same level. So Sastasundar in next 1 year, I am completely hopeful we will reach at the level where we handed over it to Flipkart.
Perfect, sir. And just to confirm, sir, in your opening remarks, you mentioned that Retail Shakti will be EBITDA positive starting from next year, and at this point of time, Sastasundar is positive at the contribution margin level. Is my understanding right?
Yes, absolutely right. And I'm very happy to say that in January, if you see the January month, then January month Retailer Shakti is already EBITDA positive, and Sastasundar is already a contribution margin positive. So I'm firmly hopeful that the next quarter in Retailer Shakti, we should be EBITDA positive, and EBITDA positive, there will not be loss, 0.1% EBITDA, but next year, Retailer Shakti, we are hoping to have 1% EBITDA. And Sastasundar, we are already contribution margin positive company in the month of January, and next year certainly we will be contribution margin positive company. And Sastasundar also this cost of futuristic cost, we are incurring with a purpose. If I just tell you the example of how the Retailer Shakti and why the Sastasundar. So I tell you that the case margin, case generation capability in Retailer Shakti is 4% of the revenue for, say, after 5 years when it developed, say, its turnover at that point of time is 5,000 crores. Say, just for an example, the Retailer Shakti business model will generate 4% of the case. So that is around 200 crores. But the Sastasundar case generating capacity will be 8%, that is 4% more. So say Sastasundar's revenue is 2,000 crores. So we will generate case 160 crores. So against that 160 crores for next 3-4 years, if we are investing 125 crores, that's a wise decision. And this is basically purely a trading profit loss. And then the type of evolvement which is coming into artificial intelligence and type of a composite logistic model. I mean, you can compare any other company in India, and I would be happy to gain my knowledge. I mean, we have given in the presentation on page number 14 that our total capital raise is 350 crore, and I have posted a 9% post-tax cost of capital raise 431 crores. The total capital deployed is 783 crores. Out of that, 100 crores we repaid to the Mitsubishi. Net capital out of buyback is 7683 and treasury is 403. Net asset is 197. So the IPR business, the capital deployed is only 83 crores. This 83 crores, if I composite say for next 5 years, with cost of capital will become double 200 crores. This 200 crore I realized in 1 year in Sastasundar alone. And Sastasundar, when we partner with Flipkart, we realized out of 75% stock, 800 crores rupees. So any one IP, I mean, the Sastasundar Health and Happiness podcast itself, a YouTube channel, can generate this kind of profits in next 3-4 years time frame. So this is the business, only 83 crore rupees we have invested in building the entire company, IPs, including Retailer Shakti and Sastasundar. And you can compare any other digital company in India which can demonstrate this kind of capital efficiency and working capital efficiency. I will be happy to learn.
Exactly. Significant achievement. Thanks a lot for detailed explanation and all the best.
Even a small startup which raised 83 crore, 100 crore rupees, burn that money in 3 months' time.
That's true, sir. That's true. All the best, sir. Thank you very much.
Thanks.
Thank you. A reminder to all the participants, please restrict yourselves to 2 questions at a time. The next question is from the line of Jatin Jadhav from Shahsrar Capital. Please go ahead.
Hello, am I audible?
Yes, please.
Yeah, I have 2 questions. The first one is, how should we think about the capital management between Retail Shakti and Sastasundar B2C over the next 2-3 years?
So both businesses are one for us. So large part of the capital goes into the fulfillment center building or technology building where the capital goes on. And Retailer Shakti, as I already said, is almost break even at corporate level, including its corporate costs. So Retailer Shakti, we don't find any major capital outlay for next 2-3 years. It is self-sustainable level. And Sastasundar, as I have already said, that we earmarked 150 crores to spend for building new technology. Out of that, around 50-60 crores we already spent. So another 100 crores that will be funded through the treasury income for next 2-3 years time frame. So the company's capital and treasury will be intact, and out of the treasury income will be investing for building futuristic Sastasundar platform, including Zito. So if you find there are some companies which are building their own brand specific retail distribution channel, and you see their capital investment, and that kind of company in the company itself will be able to build without any investment. So that kind of efficiency we bring on table, that a absolutely distribution of generic brand is being launched, is being scaled up without any capital outlay.
Got it. Thank you so much. My next question is, what advantages does Retailer Shakti have versus its peers like Entoro or any regional distributor, especially if competition starts increasing?
Very good questions. I would request to please see page 5 of my presentation on the stock exchange, where we have clearly demonstrated that how value additions we give to retail pharmacies. So there are four factors which are main. One is the reliable fulfillment of all medicine needs. So any retail pharmacy say wants to procure out of 50,000 SKUs, they have to depend upon 15-20 distributors. There is no one distributor, and that is very inefficient. These distributors take around 10 to 15 days time to fulfillment. There is no certainty. Here is a Retailer Shakti. Today, any retailer gives order online. Next day, there is a guaranteed delivery. Thereby, they ensure that guaranteed delivery is there. They are able to reduce their inventory level by ensuring the guarantee. Then we are only company which give them clear discount scheme, absolute transparently on the screen without any discrimination. Our margins are certainly better that we give instead of credit, but again the credit cost also that becomes more superior for them, and there is a absolute easy to return policy that they just need to put into scheme, next day lift the good materials from them. So these are the 5 clear-cut benefits. One is reliable fulfillment of all medicine needs, better margin instead of credit, help reducing inventory level, clear discount schemes, transparent pricing, and simple return process for unsold high inventory. So these are the clear things, and then I'm very happy to inform all of you that soon we will be launching a retail air. That will be the AI-driven SaaS platform that will be given to all the retailers free of cost. From there, they can manage the inventory, they can manage their billings, and they can automate, put order into retailer Shakti. So this we will be launching in another 3-4 months time, and we have invested around 10 crore rupees into this retail air, and this will be available without any cost to all the retailers who are attached with retailer Shakti platform.
Right, so those are the 2 questions. Thank you so much and all the best.
Yes, please.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. The next question is on the line of Dipesh J. Sancheti from Manya Finance. Please go ahead.
Hi, am I audible?
Yes, please.
Yeah. You guided for PAT positive next year, supported by treasury income. How should investors think about core operating PAT excluding treasury?
That we disclose every presentation. Every quarter to quarter presentation we show separately how the treasury income is and how is the operating profit. And as per Indian accounting standards also, the balance sheet, profit and loss account, quarterly results we also give separately. So if you see the presentation which has been posted to the stock exchange, given separately.
I'm talking about when will we get PAT positive without treasury income?
Okay. So PAT positive, there are 2 components. One part is the retailer Shakti, and one part is the Sastasundar. So retailer Shakti, the next year we will be PAT positive. This is our working is for which we are working. And Sastasundar, we aim to be PAT positive sometimes in year 28, 29 or 29, 30.
Okay. And this Jito which you have launched, is it connected to the Jain International Trade Organization? Is it similar to this? And are we leveraging that, that Jito also?
No, I mean, we don't find any connection with the Jain International. Jito is our registered trademark, and it's for medical and medicines. This is our registered trademark.
Okay. And what specific strategies in your inventory management or receivable collections are optimizing this working capital cycle? Because those are the 2 key variables for us to get a positive cash flow.
Yes, so we are the best company in terms of the capital efficiency. So we don't give any credit, so there is no headache for managing the receivables. For inventory, we have clear-cut demonstrated and developed a AI-driven algorithm whereby we can predict our demand very nicely, very happily. And we have built a direct relationship with almost all the pharmaceutical companies in India. And going forward next 5 years, we think that we will be a negative working capital company because our inventory will be at 22, 23 days time, which will be funded by pharmaceutical companies by giving similar kind of credit. So we are working towards that, and this company will be running without any working capital need.
Great. Thank you so much, sir. All the very best.
Thank you. The next question is from the line of Abhishek Singhal from Perpetuity. Please go ahead.
Sir, thank you for taking my question. I just wanted to understand, because I was hearing from you the fact that the model you're building is very capital efficient. And, we might either have a negative working capital or at best, say, 10 days or with some investment in Jito a bit more, which essentially means not more than 5% of sales is your net working capital requirement. Now, in that scenario, when you start hitting 5,000, 7,000 crores kind of a top line, the total deployment required will still be significantly less than the cash that you have in hand. And plus, in our journey towards that 5,000, 7,000 crores, we actually start generating cash. So technically, the cash that is lying in our books at this point of time, a part of that might not be required for growth. So I'm just thinking aloud, sir, and given there is some change now with the government proposing for buybacks and the way our stock is today valued at around 0.5 times EV to sales and stuff. So is there a thought process inside that there could be some distribution of cash through the buyback route?
Yes, why not, Abhishek? As we have demonstrated the current year, we bought back capital of Mitsubishi from the same thought. So 100 crores we paid to Mitsubishi. And because this is a step-down subsidiary, so first action we have to complete the merger in the holding company for which we are working. So post-merger, and yes, this will help that there is a government initiatives to make the buyback free. So we don't intend to hold cash unnecessarily which belongs to shareholders. So, and by that time, I think from 2 years now onwards, our merger will be completed. Our capital investment in Sastasundar will be almost over. We can see that whether we can do the buyback, and I can recommend to our board of directors. And yes, this is a very thought upon which we can work upon.
Okay, so that's quite helpful. And sir, just on the retail Shakti side, you talked about...
Sorry to interrupt, Mr. Singhal. Please rejoin the queue for more questions.
Sure, I'll do that.
Yeah, thank you. The next question is from the line of Saket Kapoor from Kapoor and Company. Please go ahead.
नमस्कार साहब एंड थैंक यू फॉर द सर फर्स्टली अगर आप वो धन्यवाद सर इफ यू कुड जस्ट एक्सप्लेन द मर्जर प्रोसेस एंड वेयर आर वी सर एंड पोस्ट द मर्जर हाउ विल द एंटिटी लुक लाइक सर आई एम न्यू टू द कंपनी सो पार्डन मी देयर
So the post merger the Sastasundar Ventures Limited, first thing is that we are changing the name. So next 10 days the name will be changed from Sastasundar Ventures Limited to HealthX Platform Limited. So in HealthX Platform Limited, this healthcare company Sastasundar HealthBuddy will be merged. So HealthX Platform Limited will have all the business of Sastasundar HealthBuddy Limited, which is a digital healthcare platform business. And then there is a NBFC company which is called Microsec Resources that will be demerged and will be listed separately. That will be an NBFC company, and that will be listed separately. So every shareholder who are right now is the shareholder of Sastasundar Ventures Limited will have shares of Sastasundar HealthBuddy Limited. The 80% holding of Sastasundar Ventures into HealthBuddy Limited will be distributed among the shareholders of Sastasundar Ventures, and Sastasundar Ventures Limited shareholder will get another share of NBFC company Microsec Resources. So that is how it will look like.
Okay, so there will be two different entities for the nature of different activities that we do. That is how
Yes,
it will be.
Two focused entities, yes.
Two focused entities. Sir, and when we look at our peer comparison, Anterio would be the only organization where we can look at a like-to-like comparison, or depending upon the business model, since it is mentioned here that we procure medicines in bulk from the manufacturer. So, if you could just give us some more understanding on our peer comparison.
So the peer comparison, I would request you, definitely we also see their balance sheet and performance. So at a business level, we are similar to, say, Keymates of Apollo Group or Intero of this nature. So business buying medicine, storing and selling to the retailers, business-wise same. But the key differentiator you must factor into that what are the key differentiator. One is the credit-driven business, one is the business by building a case company. And second factor, once you build the case, you must also see that building business like Intero, how much capital they have to put to buy the rights of a pharmaceutical company, that is called the distribution rights. And you must recognize the fact that company like Retailer Shakti, Sastasundar, we have not spent a single penny to acquire any right. And 95% medicine across geographies we buy directly from pharmaceutical companies. That is how there is a strong differentiation in the businesses. You must also see that how much capital Intero is deployed, how much capital the business model like us can deploy. So capital versus the cash generating capacity. In next 4 or 5 years, you must build into two businesses. Then you will find very effectively the differentiation. So business-wise, you can definitely trade as far as the gross margin is concerned, as far as the growth is concerned. And then growth, again, organic growth or bought out growth. So bought out growth needs capital, and then the shareholders' hard-earned money goes into that, and then where value accretion is difficult. So that is how you can factor into. So definitely you can follow those companies, but I would sincerely request you to study my presentation. In this time, I have given a very comprehensive presentation on the stock exchange, and you factor into capital efficiency, growth efficiency into that model, and then you factor into how much ROE, ROCE we are giving, how much ROC this model can give, then the comparison will be right.
Okay, sir. I'll definitely go through and then come back again. But second question was on the post-merger, what would be the promoter stake in both the entities?
So as of now, the Sastasundar Microsec Resources NBFC promoters will be the same thing, and in Sastasundar Healthbuddy Limited, the promoter equity will be around 58 to 60%, depending upon the ratio.
And for the for Microsec, sir,
Sorry to interrupt, Mr. Kapoor.
No, it was only, sir. I was answering. I missed his comments, madam. No question.
So the Microsec Resources will be 75% promoters,
75%.
and HealthX it will be 58%.
Okay, sir. I'll join the queue, sir. Who will be the remaining shareholders for 40%? That would have been my question. If you could answer that, I'll join the queue.
Yes, definitely. So the one will be the Roto Pharmaceutical Company, which holds around 16% in Sastasundar Healthbuddy Limited. This is Japanese, one of the largest eye care company in the world. That will be holding, and then some FI, some QIB, and the balance public.
Right, sir. Thank you, sir. I will do my due diligence, sir. Dhanyavad, sir.
Dhanyavad.
Thank you. The next question is from the line of Athar Sayyed from Smart Sync Services. Please go ahead.
Hello, sir. Thank you for the opportunity.
Thank you.
Yeah, good afternoon. Athar here from Smart Sync Services. Sir, I wanted to understand, like, I'm little new to this company. First time attending your con call. So just wanted to know, like, what is the differentiator between us and our competitor in terms of like how we operate? Because if you see, we are just like a distributor. So anyone can enter into this segment also, and also the old player like Pharmacy and 1MG and other people also started these businesses. So what is the key differentiator between us? If you could explain, it would be great.
A very good question. So, sincerely request you to please download my presentation into BSc, NSC website and see that we have given our X factor key differentiators. So our core operating capabilities, one is key differentiator is our efficiency. So we are the most efficient in terms of putting capital. We built the entire IPR business there by just putting 83 crores. We have given the detail on page number 14.
Sir, actually, if you don't mind, I actually heard these things. But apart from this, I wanted to understand, like, in Mumbai, government also started, there is something called as Jan Shakti Ayushman Kendra. Like, it is a government-backed medical center, so basically. So I also met some pharma companies also 2 years back. They also said that the biggest margin also to take by distributors like companies who distribute pharma products. So government has started this program where they directly cut off these distributors and directly taking these pharma products from the companies and selling it through the medical. So it is not what we can say, very tough for us to maintain our business and change this industry.
No, I mean, the government cannot deploy the technology into any type of business and cannot build the distribution network. That is not the government job. So whatever government does for making access and affordable healthcare to retail public, to general public, not for distribution network. And even if the government does, I mean, they will do, definitely they will do, because there is a very, very large market. So we will also do, and the government is doing in West Bengal also, but we are the market leader. So that you see the competition builds more business. And the business where there is no competition, there is no growth also. So this will keep on going.
But it will slash our margin as well.
Sorry to interrupt, Mr. Sayyed. Please
It is
rejoin.
my only one question which
Please rejoin the queue for more questions.
I'm.
Thank you. The next question is from the line of Padini, an individual investor. Please go ahead.
Yeah. Thank you for the opportunity. So I was wondering in terms of, in the presentation, the company has laid out the fact that for Health Buddy, the contribution margin is going to be 0.5 to 1%, whatever is left over. So I was wondering for Sastasundar, what is the split between let's say online versus the Health Buddy distribution channel? First question. And overall, how is the margin different from both the channels, let's say Health Buddy versus the Sastasundar app? And how was it planning on scaling? I understand that you want to scale it up to, it will be PAT positive by the end of 30. Could you just give what are the milestones that we need to keep tracking, and how is it going to go there?
So I must explain you that Sastasundar app and Health Buddy is the same kind of model. They are not two differentiated models. Health Buddies are the local partners on pin code wise who handle the prescription checking, compliance and last mile delivery. So the Sastasundar as a company we receive all the 100% orders through digital medium. Substantial more than 50% orders come directly through app. Some orders come from the dashboard which we install in the Health Buddy service center. So these are only one model, and the contribution margin which we are talking about Health Buddy is the integrated margin of Sastasundar app and Health Buddy.
So we'll only have 1% margin, 1% contribution margin from this particular business, right? That's the idea.
As of now, yes. And from next 2-3 years, this 1% we expect to rise around 8%.
Understood. And one more question regarding, you mentioned the fact that the previous participant, that a lot of distributor companies spend a lot of money in acquiring the pharmaceutical rights. Could you explain why does Sastasundar doesn't need to spend it, and how much are we saving because we don't need to spend, and why don't we need to spend?
So we have not spent any single penny of acquiring any rights. Whatever money we are spending and is building our technology and building our brand. So that are paying off to us and will continue to pay in future.
But why don't we need to acquire those rights? Because we're just taking it from the pharmaceutical companies. Because as far as I'm aware, you need to get the code from the pharmaceutical companies to distribute in a particular area. So do we need to pay for it, or how does that work?
So that much I am telling you, that we acquire those rights basis on our efficiency, basis on our capabilities, basis on our fulfillment centers quality. So they work with us initially through distributors. Then they have seen us. They have seen our terms of payment. They have seen our goodwill. They have seen our working capital, and they are happy to work with us without any payment of distribution rights.
So basically, your goodwill is your payment to them, basically. Is that right?
Yes. I must tell you that never in our history of the company, we have not delayed a single day payment to any pharmaceutical companies. Our tax record is absolutely 100% right. We have not dispute of any kind of any single paisa with any pharmaceutical company.
Understood. But if you were to spend that money, how much do you think you've saved by having such a strong marketing, strong brand presence in the market? So over the geographies we already are in right now.
Sorry, please repeat your question. We didn't get your point.
So basically, I understand that goodwill is saving a lot of cost. By having the goodwill, you're getting the pharmaceutical company's distribution without paying any rights. I was just wondering, for us to understand as shareholders, how much did the company save by having that goodwill versus, let's say, another distributor coming into the market newly for the existing geographies? Like what percentage is saved because we have goodwill?
So that you can compare, say, if any benchmark of the market, the other markets are purchasing around 30% of the revenue for rights. So say our revenue of retailers is 1,000 crores. So 30% of that is coming around 300 crores. So we are going to buy the distribution rights from a offline distributor. We have to pay 300 crore rupees.
Understood. This payment you're talking about just acquiring the distributor.
Sorry to interrupt, Mr. Praneet. Please rejoin the queue for more questions. Thank you. The next question is from the line of Avnish Tiwari from Vicaria Fund. Please go ahead.
Hi. Two questions. One question is this, when you are supplying your own trade generic, Jito, to pharmacies, wouldn't that be a conflict with your pharmaceutical or marketing companies who are supplying medicines to you, because it will undercut them? That was the first question. Second, very combined because you're on the tight schedule here. Second was that when you're talking about somebody else, your competitor growing through acquiring distribution rights, why, is it just that you are able to grow organically at a high rate, or if you were to also grow at high rate, you also will need to do some acquisition? Like 30% growth aspiration which you have, can you do that organically or without acquiring these rights? That's the second part.
Yes. So second question, we are fully confident that we can grow 30% plus year by year for next 10 years without any acquiring any distribution rights. That is number one. And number two, we don't find any conflict between Jito generic and the branded medicine. Both these are two segments. There are two separate kind of customers. The people who will buy the branded generic, they will continue to buy the branded generic. The people who will buy the Jito generic, they will buy the Jito generic. And this conflict between branded generic and Jito generic or any other generics, we don't find any merit from the perspective that 100 crore new Indians are coming to buy the medicine hitherto, but not having any access. So there are 100 crore people. Out of that, around 20 crore people are suffering from either one of the chronic disease, diabetic, blood pressure, heart disease. They don't take medicine because they don't have access to medicine. Now the India is rising, is a fourth largest economy, is going to be a developed country by 2047, and thereby a whole bunch of 100 crore people will come in the medicine bracket. They will need medicine, and because they have the limited capacity of paying, this generic will grow very rapidly, and we want to capture that state in a very calculated move. And both markets are different markets. Both are different customer based market, and there is already generic medicine which are selling into the market, something not new. From last 50 years there is a market, but that is growing very rapidly nowadays because of the new customers who are coming. So I hope these address your questions.
Yes, yes. So you're going to sell to same retailer, or will it be two different kind of retailers in which you will market branded generic versus Jito?
So all four formats we will go aggressively. I mentioned in the presentation about all four formats.
No, I meant to ask you that one pharmacy retailer is there. You will be selling both Jito and the branded generic which you have purchased?
Yes, both are available at the digital platform. They can buy both. So this is another medicine like any other medicine.
Got it.
So we don't go to retail pharmacies to sell. They make order online.
Achha, they purchase online only. Okay. Great. Thank you.
Welcome.
Thank you. The next question is from the line of Saket Kapoor from Kapoor and Company. Please go ahead.
Sir, thank you for the opportunity. Sir, slide number 20, when we have mentioned about warehousing and the expansion that we are doing, sir, इसमें हमारा cost involvement कैसा रहता है, and sir कौन सी medicines किस region wise कितनी requirement रहेगी, how do we work out, जिसमें आप AI का part क्या देख रहे हैं आगे play out होने में, how much will we be needing to invest in the technology? And sir, second question was regarding at what valuation did the investors which you mentioned, I think so the Japanese and the biggest retailer from I think so from Japan, at what valuation they invested in the company which will be demerged, which will be merged with Sastasundar and then getting demerged?
So the Rotta Pharmaceutical invested at around 225 crores valuation. The Mitsubishi invested around 700 crores valuation. And second question is about building your new warehouse, additional investments. So the additional investment in building new warehouses, we are still working at what kind of facility we require. But I can tell you the West Bengal, where we have placed the order. So West Bengal we will be investing around 10 crore rupees for additional capacity of 80,000 square feet warehouse. And Noida we are working, so I am not able to give you the exact figures. So these are the things. And The AI automation, yes, this will be a good part because, but any automation cost we recover in 18 months of time. But we believe that going forward, because of the substantially improvement in the AI technology, so this picking process, the raking process, the dispatch process, all are, will be run by the AI, the route channeling, the delivery part, so payment receipt part, all AI will play the major role. And we have a complete team. As I have said that we already earmarked 25 crore per year budget on the artificial intelligence studio team. That will be building both for Sastasundar and Retailer Shakti, and we don't find any additional expenses on any part of it.
Okay. So you mentioned 10 crore investment.
10 crore, yes.
10 crore in the... Okay. Right, sir. I'll join the queue. So if I may add only one part, when you were mentioning about the differentiating aspect, in the aspect of the legal aspect, are there any big entry barriers that our model cannot be replicated by other people, since everything is in the public domain and we are giving more insights on how we work? What would be the key enabler or the key entry barrier that makes us a differentiator, and it will take more people, it will take a trouble for the other people or to replicate our model? Because as you mentioned that the volumes will grow substantially over a period of time.
You see, the first entry barrier is building the relationship with all pharmaceutical companies. So either you have to buy the distribution rights from the existing distributor. There's a very cascading effect, will take 10 years time frame, and you have to spend say 2,000 crore rupees to buy those rights. Second is the building technology. So building technology, anybody has to spend 5 years time frame. And third is bringing the warehouse efficiency. There is again a 5-year job. So it's not an easy task. It is not only tech company where I build the technology and start. It's a technology plus fulfillment capacity plus relationship with pharmaceutical companies, which works in a very tight zone. And then the bringing all sort of retailers, all sort of consumers. So I must say that like Zomato, like Blinkit, these are open mode, everybody knows, but it's not meaning that everybody can start company like Blinkit or company like Swiggy. So these are the things. Every business, there is nothing to hide upon. So it's an execution. Idea is not new. Execution is the new.
Yes, sir. Yes,
yeah. So execution is the differentiating factor.
So you mentioned about the alignment.
Sorry to interrupt, Mr. Kapoor. Please rejoin the
Yes,
queue
ma'am.
for more questions.
Ji, ma'am. Correct.
Thank you. A reminder to all the participants, please restrict yourselves to one question. The next question is from the line of Athar Syed from Smart Sync Services. Please go ahead.
Hello, sir. Thank you for the follow-up. Sir, just wanted to know two aspects of your business. One is working capital, like how we don't give credit to our business, medical store and all, retailers basically. And second is what is the average EBITDA margin in this business? Like in terms of Antro, it is 4%, but our EBITDA margin is very much fluctuating. Sometimes it is 3%, sometimes it is 1%. So what is the on an average EBITDA margin in businesses?
So first, if you compare with the Entero, you must compare them how much capital they have deployed. And you see 9% post-tax return on equity and then calculate their EBITDA margin. Then you will find that they are EBITDA negative. If you deploy your Excel sheet from the day one, how much capital they have taken from the shareholders, put 8%, 9% CAGR on that, and then bring how much money is coming. So EBITDA itself showing is maybe a misleading factor if there is no return on equity and if there is no economic value addition. So our company, you must see that from economic value addition perspective, we have given the detail working how capital has been efficient, and we have given the detail IRR on the capital also. So that you must see, and the EBITDA positive will be the cash generating capabilities, and EBITDA itself is we don't see. I personally see the cash flow that comes from the paid. So say my company is making 4% EBITDA positive. So what? 2-3% you will find is the depreciation, 2% is the interest, and the net cash flow will be less than 10% of the return on equity. So if I am building a company whereby the return on equity after depreciation and after tax and everything is 10%, what is fun of making that business? We are building a business which we can generate return on capital employed by more than 50% year by year, which can generate the cash flow and which can really build a great company without much of the capital. So these are the two differentiating points, and I must request you that you must analyze in your deep research, and then we can make another debate.
Okay, sir. Got it. Thank you.
Thank you. We'll take a last question from Saket Kapoor from Kapoor and Company. Please go ahead.
Yes, sir. Only a concluding point about our relation with the pharma companies and we getting an edge on other companies. So how had we were able to model it out in a way that we did not have to pay those registration fees and as you were mentioning about when comparing with other players in the same space, what correct steps have we taken that we have been able to do so, sir?
So I think the first part is the hygiene of the warehouse and hygiene of the fulfillment center. So if you see in India, the most of the distributors' warehouse, if you visit, those are in old kind of structure with tin on the roof and not very clean, not very hygiene, not very cold storage. The Sastasundar fulfillment centers are all international standards. All are absolutely modernized, absolutely air conditioned, and with a good hygiene practices. All employees are fully paid employees. And then if you see the very prominent figure is the purchase return. So you must be aware that all pharmaceutical companies accept the return of expiry drugs. The industry average of those return is more than 2%, while Sastasundar's return is less than 1%. So that is how they save. In Sastasundar's history, we never delayed any payment to any pharmaceutical company by even for a 1 day. So absolutely timely payment and absolutely predictive demand and absolutely cooperation as far as the distribution is concerned. And then the second factor, we give them reach to tier 2 cities, even villages where they were not able to reach. So if you map the West Bengal area, in 30% of the area, they don't have any distributor, but they have the retailer Shakti, through which they can reach to anyone, anywhere in 24 hours. So that kind of the reach to pharmaceutical companies, and with a efficiency model, with a goodness in terms of inventory, this is a strong value addition we add to them, and for that they are happy.
Right, sir. And sir, for warehouses in West Bengal...
Sorry to interrupt, Mr. Kapoor. We have other participants waiting for their turn.
Fine.
Thank you. The next question is from the line of Amit from Robo Capital. Please go ahead.
Thank you for the follow-up. So my question is on retailer Shakti. I was looking at some numbers. I think last year we did about 950 crores of revenue. And this year, if I calculate, I seem to have missed the number if it is in PPT, but the number could be in the range of 1,100 or 1,200 crores or so. So we haven't grown much this year compared to last 3-4 years. Earlier we were growing, above 100% CAGR. I understand the CAGR can come down, but this looks fairly, lower growth this year.
No, I fully understand. I am aware about, as I mentioned in my opening remark also, that this year, due to the automation issue in our Baripur area, though our growth was not that much as happened in the past year, but that was sorted out. And if you see in this quarter, that growth has come back. So we grew by 10 to around 10% Q to Q. And I am happy that January, February, March may be the one of the best quarter in the company. And looking to the January trend, so that growth has come back.
Yeah, so we are confident. I mean, you think that
Sorry to interrupt,
orders
Amit.
have now been...
Sorry to interrupt.
Yeah, I'm not asking a question. I'm not asking a question. I'm just...
No, we are comfortable by growing 30% year
Yeah.
CAGR for next 10 years. In between some quarter, there may be some issues.
Okay, perfect, sir. Thank you. Thanks for the opportunity.
Thank you. The next question is from the line of Avnish Tiwari from Vikarya Fund. Please go ahead.
If you were to compare your reach in terms of number of retailers you are reaching out to and the revenues you generate compared to, let's say, Entero, how would you compare that metrics? I understand capital efficiency and all other things you described are really, really good at your end.
So the availability is the key issue. So any retailer who is opening or running the shop, they has to deal with 20 distributors. So instead of 20 distributor, he can deal with one distributor only. So that is the most part. And on an average, any retailer has to keep 40 days inventory because of the uncertainties in terms of the fill rate. By retailer Shakti, that can come down from 40 days to 10 days because there is guaranteed next day delivery. So his inventory level is substantially low. So these are the critical things which we hold as a competitive advantage.
No, I meant to ask you that your revenue from retailer Shakti and number of retailers you are reaching out to compared to Entero's revenue, which is much higher, and number of retailers they are reaching out to. So, is it right to find that they are generating more revenue from a similar number of maybe per retailer they are reaching out to compared to you, or there is other way to analyze this?
No, there is no other way because they are a credit oriented company, so their relationship with few retailers will be very, very deep because they give the credit. So per retailer wise margin, because of the credit orientation, the retailer Shakti is a superior model. This Entero is a superior model.
Not only margin, per retailer revenue also you think they will be higher because they are giving credit?
So the revenue higher, but at the end of the day, by making revenue higher, by giving more retailers credit, what I am making, that is very important. So you see that whether that model will give you 15% ROE for next 2-3 years. If the 15% ROE any company cannot make, then what is the purpose of the business?
Got it. Understood. Thank you.
Thank you. Ladies and gentlemen, we'll take that as the last question for today. I now hand the conference over to the management for closing comments.
So, my dear friends, I thank you very much. I would again request you to go through my presentation, which we have posted in the stock exchange. That we made a very detailed presentation giving our business model as well as our futuristic plans. And please bear with me any sort of quarterly fluctuation because we are a startup company. We are still building the great company for India. Thank you.
Thank you very much. On behalf of Go India Advisors LLP, that concludes this conference. Thank you all for joining us today, and you may now disconnect your lines.